Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Sundaram Fasteners, an interesting small cap auto ancillary company. Let's understand when the move will start, and let's understand when should you invest. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Sundaram Fasteners, I just want to request that kindly support me on Patreon. And once you do that, it will help me grow the channel. It will help you also ask me questions on a daily basis. And once you get a membership of Patreon of $10, you'll have access to some of the podcast and articles that I put up. Some of these are like this. I put up today a podcast on a pharma stock that could go big from here on in. Updated portfolio of mine. This is a 10th August portfolio, if you can have a look. Strategy of how to deal with mid cap, small cap volatility. Then I put up portfolio updates. I regularly put up portfolio updates whenever I make up changes. There are discussion about Deepak Nitrite. There's discussion about Maruti, Reliance, chemical stocks, Kilpist, and I regularly put up either podcast or articles about whatever stocks and markets. Plus, you can ask me a lot of questions. So there are messages right here. So I cannot show you messages, but you can ask me questions on a daily basis. There are questions pending. There are more than 100 Patreons currently with me. So there's a lot of stuff going on. So take the $10 membership, and you'll have access to a number of points with respect to my portfolio, my watch list, and whatever I have to put up, I put up beforehand on you before YouTube. I put it up on Patreon. Now about the company. So Sundaram Fasteners was established in 1962. They are into auto components manufacturing, and they have expertise in making fasteners and spare parts of autos. They boast of marquee clients and spread across India and some countries abroad in Europe, and some in Europe. So they are spreading and exploring opportunities abroad as well, and they have clients abroad. They also produce rear view mirrors, so that's also an expertise that Sundaram Fasteners have. Its clients include Suzuki, Honda, Yamaha, Bajaj, LML, etc. So there are a number of clients that Sundaram Fasteners have. If you look at the numbers, then the market cap of the company is around 8,000 crores. The sales are 830 crores versus 1144 crores. Profit has halved to 52 crores, and this is the March quarter numbers, and the debt has increased over time. There's a decent dividend yield of the company. The management is pretty good, and they have done exceptionally well during the time when the sector was doing well between 2014 and 18, and the company really did exceptionally well for the investors and making money big time for the investors. The stock went up some 4 or 5 times at that point of time, even more than that. I think closer to 7 to 8 times. Decent combined promoter and institutional holding. I won't say that's a huge promoter like holding, but it's a pretty decent holding that we have there. If you look at the performance of the stock remained steady till February 2020. It did reasonably well, and was doing fine in this auto ancillary pack and all, but did fall 50% from these highs in the February and March fall. So probably the stock, you can say, on a 2 year basis was coming at a 50% discount. Recovery has not taken place that big as with other auto ancillary companies. Those companies have not reached new highs or to their near peaks. What has happened is that the recovery has taken place somewhat, so it's up 20 to 30% from whatever levels it was trading at in later half of March. But it hasn't been, you can say, a V-shaped recovery that we have seen with other stocks. Numbers are steady. Even now the numbers are not that bad, although the sales and profitability has declined. But we have to understand that the business will pick up once global demand picks up, once everything normalize, and return ratios are low because of lower demand at the moment. So it needs to pick up, and I have a feeling that over the next 6 months, or at least 4 months, not 6 months. 6 months could be even a longer time frame, but over the next 4 months or so, next 1 or 2 quarters midway, things could normalize on the autos and auto ancillary front compared to what it was, say, 6 8 months back. So why there has been a slowdown? So auto industry is under complete stress. So currently some of the biggest industries that have taken a hit with respect to their running out inflow of funds are textile, but to an extent unorganized sectors of small businesses, and the auto industry, because automobile, if you remember, in April, Maruti sold not even one car. So that was the kind of, you can say, depression that the auto industry has gone through. So if OEMs are not selling cars, then how come ancillary plays would make money? They have even lower margins of making money. So they have got stuck up, and that's why the biggest problem in the June quarter has been of total shutdown of the businesses in the auto industry. Things are getting back to normal from September quarter onwards, and this month in August. But you have to understand that the commercial vehicle segment has also not worked that well, and they produce a lot of stuff for the commercial vehicles, and the CV segment may take at least a year to come back, and that is the reason why this stock has not really recovered so well compared to maybe some other auto ancillary plays which have done exceptionally well even after the March fall. Economic slowdown has hurt the infra to the core. The infrastructure space has been hurt. The global economic slowdown has hurt the global demand for such products, and that has not also helped in terms of sales and profitability. And remember that most of the participants in the markets believe that the auto industry will be under stress over the next 6 to 8 months. So probably maybe April to May next year they'll have a look. But I have a opinion that although there is a projection of a stress for the next 2 years, I have an opinion that over the next 6 to 9 months things should normalize, and we could see a situation where the stocks may start performing. The industry as a whole may recover after 1 year, but things should normalize on the stock front from February, March onwards. So one can have a look at this point of time little bit, not that they have to go gung ho over this stock. Uh, uh, it has led to the sector being out of favor, but I think from next year onwards the sector may come back into favor. If you look at the technicals of the stock, then the major long-term support lies at around 350, and a resistance zone is around 470 to 4 to 500 levels. So any dips towards 400 should be bought into, or any up move above 500 520 should be bought into. Stronger up move is expected above 580 levels, so keep that in mind. So if a breakout suddenly happens, then you have a price in mind that above it you can go ahead and buy. May have seen the major lows that have taken place around 300 350. The lows took place. I don't think those lows will be revisited again. Extremely weak on charts, but it is getting better, and probably best to buy would be above 550 levels. So my call on the stock is, if you have it, then hold it. There's no point selling at this point of time where the recovery may take place in a couple of quarters. Avoid if you do not have it. Probably buy in little bits over the next 8 months, 9 months as an SIP, and see what is happening with the industry. I have a firm belief that over next 1 year the industry should come back. So it's a 6 year play. Remember, if you're getting invested in the stock, it's not a 1 or 2 year play. So this was my video on Sundaram Fasteners. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.